hello, and welcome to Trading the Trend. My name is James Boyd. Today's date, August 6th, and we welcome all of you here today. Just real quick, we also have with us in the chat Scott Thompson. Say hello, Scott Thompson. You'll see his initials as ST. Now, this session is a live session, but it's also recorded, and I'll share with you that playlist link in just a moment. Now, just real quick as we're getting started, I want to kind of see who's here today. We got Will with us, Richard, Josh Pink, Olga, Trader Joe, Janelle. Hello, Janelle. And also we got with us Grace, Sam, El Trio, and many others. Welcome to all. Now, just real quick, remember that I do post educational content on X. There's my handle, @JamesBoydCS. When you go to that page, which I'll show, that page will look like as follows, and I'll send this in the chat box right there. Now, what you're now going to notice is, and when you click on, so if you look in the chat, you're going to see a link, and it will take you to this page. So if you'd like to follow me when I'm not teaching, that's where I post, and I occasionally post pretty frequently, okay? Well, almost 23,000 posts in about 5 years or so. So just a little bit. Now, if you're also new, you're going to also want to know that if you go to youtube.com, we have a channel. That channel is called Trader Talk Schwab Coaching Webcast, and that is free to subscribe. And you're going to notice that also with that, we do simulcast our webcast on YouTube. So if you have a phone, if you have an iPad or any device, just mobile, you can watch our content. You do not have to be sitting at a computer to actually see that. Now, pertinent to this class, okay? So with each different class series that we have, there's a playlist for that, okay? And you're going to see that last week we talked about tech sector, fires back up, what areas to watch. So think of this as your favorite show, and you're going to see that there's different episodes for the show. Same idea. Now, I want to kind of also make mention as we get started here that some of us might not know that if you went to also schwab.com/coaching, you're going to see that there is also and I'll put this in the chat. And if you take a look at, let's say, the webcast, as far as the calendar, I'll put that in the chat. Just want to give you some housekeeping items right off the bat. And I'll review this also in just a moment, but I at least want to kind of start us here. Today's session, here we are, and I'm teaching the session on Trading the Trend. There is a calendar, and I sent that in the chat link. And if I open this up, you're going to see that these are the sessions that will be taught today. Now, you could go back on previous days of the August calendar and see what other classes were taught. Let's come back to this, but I just want to make sure I tell you that right up front. So this is not just a one-off. Feel free to join us each week. Speaking of that, now remember with what we talk about here today are examples of trading the trend with options. Understand that when we bring this up and we talk about different option strategies, remember that option strategies, some of them can carry a high level of risk, not suitable for all investors. The information I talk about is done for general informational purposes only. When we talk about examples, we will be showing and using the Thinkorswim Paper Money software application. And as we talk about investing, realize that investing has risk, including loss of principal. Now, when we also get started here, I want to kind of just talk about trends in general first, and then we're going to talk about some strategies and kind of talk about some of the differences a trend trader might use with options, okay? Now, I want to pull up a chart. Now, I am not trying to make anyone sick, okay? But this is actually, okay, sorry. We do have a little humor, okay? Now, the question we ask ourselves every week is, what trends are you riding? Now, so in other words, think of the capital that you have, cash. What are you doing with that cash? Is it sitting in cash? What is it invested in? Okay, like what? Just because someone's invested, is it trending? Now, the trends that we're looking for predominantly are upward trends, higher highs, higher lows. That's how we define that. Now, when you look at the S&P 500, this is the trend of the S&P 500 over the last 20 years. Now, you're going to notice that this chart starts all the way back in '07, okay, 2007. Seemed like yesterday, okay? And you're going to see that we went down to triple sixes. We should have known it was the bottom, right? Now, some of us can literally remember that bottom. And then you're going to see all along the way this trend that started out at triple sixes, then went up to 2,000, tripled, then went up to 3,000, then 4,000, then 5,000, then 6,000. Can I get a 7 and just give us an 8? Oh, that's brutal. Now, here's the deal. This is the S&P 500 over 20 years. When you look at this kind of low to high, just real quick before we look at current examples, these trends are monstrous, and they're not just full of up days and all the news was good, because along the way of the 900% return, there was bad news along the way, things that concern investors. But the moral of this story is that there was a trend. Now, think about it to yourself. How have you been trying to capture that trend? We need to first understand that sometimes that bad news, whatever it is, can cause the price to drop. That bad news could actually be maybe a point where some investors might want to buy some of that bad news. And I'm going to pull up some examples, 2 of them here today, talking about some bad news. And is it always bad for the stock price? Now, if we take a look at this and go to, let's say, a 1-year daily, where are we at now? Well, we actually, yesterday, we were at a brand new high, 77.93. Today, the second red candle. The moving averages we have on the chart is a whole moving average, the 10, which is closer to the current stock price, and the 20. Now, what I want to do is I want to kind of also just pull up just real quick. Now, when you look at the S&P, broke out, made a higher high. Next, greatest chances to make a higher low, right? So as long as this pullback that we're in so far stays right above about 7,600, just a pullback, okay? It's not bearish. We're going from a higher high to a potentially higher low, meaning that's red candles, okay? Now, the one thing I want to kind of bring up to you is the reason why I showed you the S&P 500 chart. It doesn't matter how high the market goes if the investor is sitting on the sideline. In life, we can miss a lot of examples, or I should say opportunities, because we're not educationally prepared. We don't have the skill set, and so on and so on. That is the purpose for these webcasts that are live and recorded. Now, and I'll go back to the schedule in a moment. Now, if we also look at the NASDAQ, some of you like to look at the NASDAQ, fair, okay? NASDAQ from last week to this week, we broke up inside that old channel. Many investors looking for a higher low. We'll have at least 2 examples in that area. The semiconductors, you're going to see that diagonal line that we drew from last week, kind of downward sloping. We're still holding the breakout level. Resistance levels are not just horizontal. They can be diagonal as well. If it's diagonal, you either have something where you're making higher highs or lower highs. Resistance is resistance. But that price so far still holding above. We brought up semiconductors quite a bit yesterday. 2 of them actually had earnings. We'll go look at those in just a moment here. But if you take a look at the stocks, still holding in there. Now, the Russell, if you take a look at the small caps, just briefly, brand new high in the small caps. Again, it doesn't matter if we're not educated and we don't feel comfortable to trade the trend. And last but not least, the Dow Jones hit almost 54,000, okay, or 547 on the DJX index. So something's going up. Question is the balance in the portfolio going up? That's the question. That's what the investor always wants to know. Now, what I want to do is I want to kind of talk about just real quick. This class is going to focus on trading the trend, but with options. Now, I want to kind of write something down just so we're crystal clear on, like, if someone said to you, look, I want to trade the trend, but using options, okay? Now, look, if I said, let's say stocks, we're not against stocks. But in a market where the indexes are higher, many of those good quality companies are higher priced. Now, that doesn't matter if you have $5 million, $1 million, 500,000, or 15 million. But if someone has a lower account balance or different account balances, they might say, look, I might invest some in stocks, sure, but I'm going to write kind of the $3 signs. It's going to be more expensive. Okay, fair. Now, the investor might say, well, what is a way that I could use the stock with options and try to get some potential return with a derivative, also known as options? Now, if we said, well, what type of options? If we're talking about trading the trend, well, if we're talking about trading the trend, I think one of them would be covered calls. The big thing actually about this is we need the stock, and we need 100 shares. Now, that could be kind of a little line there for us. Can we buy 100 shares? Okay, so covered calls, I need to buy 100 shares, and with that, we're going to sell a call, which is the obligation to sell shares at strike price. Okay. Now, so with that covered calls, that's one way to trade the trend. You own the shares. You think the stock's going to go up, but you're saying, I want to make from where I own the shares up to the strike price, but also give me a premium. Okay. Now, second way we could actually do this is the investor might say a long call. Now, with that long call, you're buying a call, which is right to buy the shares at the strike price. Now, the big thing actually with this is you're just trading the call option value. This is what many investors are doing. They're not trying to exercise their right to buy the shares at the strike price. They're just buying a call. And if the stock actually goes up, the call could increase in value. So the option price is linked to what the stock does. Okay? Now let's kind of think of this just for a second. You go put a house under contract. It's $1 million house. And all of a sudden, real estate gets hot in that area. And that house goes from 1 million to 1.1 million in like 60 days. Okay? Now, don't say this is an absurd example because that's not true. It can happen. Okay? I've seen it. Okay? Well, wonder if that house was under contract and you agreed to actually buy those shares of that house for $1 million. Well, that contract that you have now is really valuable. Someone might say, I'll buy you out of that contract. Well, it's the same idea with the derivative, the long call on the shares. Now, if we kind of said another one, which is a long call vertical, okay, the long call vertical, we'll just hold it there. Short put vertical, as we talk about example, I'll bring that up. And the last one we're going to bring up is long synthetics, okay? Now, the only thing I'm going to say about the vertical is these are really meant for higher priced stocks, okay? Higher priced dollar stocks. When I say higher priced dollar stocks, what does that mean to me or to us? Well, that really means for us probably anything higher than $300. This is really what we call a debit. If I said debit card, what does that mean? That means you pay with it. That's a debit. This is a credit. That long call vertical is really based upon profitability. And this is more really based on probability. And you're going to see examples of a cover call, long call, vertical, long synthetics, and I'm going to hold that to the end. Now, so the investor might say, do I need to know all these? Yes. Why? Well, because sometimes you might have good quality stocks where you say, look, the premiums are good, and I actually want to kind of maybe have something where I could try to make some stock price appreciation, but also some income on a stock that I own. Long call, does the investor need to know about that? I think some of the examples are going to show up. Yes. Okay. The investor might say, look, I just want to leverage a position, meaning they're not going to outlay the same amount of capital as a stock investor would. Verticals, does the investor probably need to know that, at least consider it? Yes. Well, because how many stocks are higher priced dollar stocks? The answer is many. Okay. And in this market, the verticals are a way to really trade the trend with options with a smaller amount of capital. In long synthetics, we're going to leave that to the very end. Now, here's the deal. So I want you to kind of think about something. We are not just going in with just stocks and stocks only, at least this class, okay? Now, you might say, James, I saw this class, it was interesting, but I'm just going to do stocks. That's absolutely okay. But if you said, James, I resonated with some of the things you actually said, man, a lot of these price dollar stocks, they're higher. What about verticals? Or when might I do covered calls? Maybe I think the stock is going to go flat or pulling back. Maybe I want to leverage the trend, or I really want to leverage the trend. There's reasons to know each one of these. Now, how many are there? 1, 2, 3, 4, 5. So I always kind of have a rule of thumb. If it's less than one hand, it's not too much to know. All right, now let's get to work here, okay? Now, what I want to do in this example, I want to bring up an example, and I'm going to go to the stock. And let's just take a quick look, okay? One of the stocks that's kind of been grinding back to the upside is a small company called Baker Hughes. It's not a small company, but let's say it was, okay? Now, if you take a look at this, again, we're looking for trends. So when we talk about any of these bullish type of strategies, what type of stocks are we looking for? Okay, we are looking for, okay, stocks that are above their moving averages. Okay, that's the foundation. Okay, so when we actually look at, let's say, the price, is the price above its current moving averages? It is. Now, if you also look on the chart, if we kind of said on a 1-year daily chart, many of the examples are probably going to be examples where the lower left is down here. Hopefully the upper right is higher than where you started on the 1-year daily chart. Okay. Okay. Now some of you, this is what I love. Wacky Wack says the name is James. James Bond. Shaken, not stirred. Boy, that is so right. Okay. The one thing that you would have to say is that when you see more markets, when you see things go down, you're not as emotionally brittle as you were before. Because you know at the end of the day, as people have cash, they're going to look to buy things a lot of the times that have been beaten down. Okay. And I can come up with example after example. The one thing is, so you're right. And I hope the biggest goal is that you learn, you take the education, and then what you do is you practice it. And then what you do is the investor is trying to get a chunk of those trends for themselves to grow their money, to reach their financial goals. Okay. Now, here's the deal. When we talk about stocks, I just want to kind of make mention of this. You might say, well, James, I'm not really a stock investor. This class is on stocks and options. But tomorrow morning, if you said, hey, you know what, James, I'm more of an ETF type of guy or gal, or I like to use stocks and ETFs, are you really saying that this is just only the investor is just doing stocks? No. With each one of our classes, there's a set topic, and then we teach the topic. If you said I'd like to learn more about ETFs, check out tomorrow's class that's live only, where we talk about ETFs. You could take some of the things that we're talking about here, and you might say, I might consider applying that to ETFs. Just want to connect those two, okay, or try to. Now, let's look at an example. Now, step one, when we talk about a covered call, we need 100 shares of stock. Now, wait, why did you choose Baker Hughes? Oh, simple example. But because Baker Hughes is a $62 stock. How do we know that these options are liquid or they even have options? Well, we're about ready to find out. So first thing is, we know with a covered call, we need to buy 100 shares of stock. How much is 100 shares of stock? $6,281. Not backbreaking, but probably more realistic for some investors that might just be beginner intermediate. Now, if I went to the trade tab, let's do this together. We're going to look down and see, do they even have options? Now, what would actually give us the idea that there might be options? Well, number one, the stock volume is higher. That's probably a good indication, okay, that the probability is higher. Second, when we actually come down here and look at the option table, there are options. When we talk about doing a covered call, we're going to look at doing something 20 to 50 days to expiration. So this 18 September, it really means that these options expire on the 18th of September, 2026. That's what that means. What does the 43 mean? Days to expiration. What does the 100 mean? The number of shares that are in the contract. So if we have 100 shares and we agree to sell 100 shares, that's why they call it a covered call. Because the investor, if they click right here, the ask price, if we buy 100 shares, now watch what I'm doing. How did I do that? Just click on the ask price, then come down to single order. Guess what we're going to do? First triggers SEQ. All we're going to do is say first buy the shares, and then in sequence, step one of the sequence, buy the shares. Step two, sell the call. Now, when you sell the call, what are you really doing? You're saying to anyone in the market, hey, you can buy the shares at 65. All right, now, if you would agree to buy the shares at 65, you're not going to do so for free. And I think you're a really nice person. But you're going to say, look, I'll sell it to you for 65, but bring your briefcase. Briefcase. Well, the briefcase is the premium. I'm just having a little fun with us here, okay? It doesn't always have to be serious. Now, what you're now going to notice is, well, how do you sell a call? Well, if you sell the call, you just click on the bid. Now, when we actually put these numbers together, and by the way, this is also a stark reminder that a lot of times people think when you learn about investing, it has to be a real dry discussion and, blah, blah, blah. If you talk to the people that are good at it, they can kind of make very, maybe in some way, hard things kind of like interesting to learn about, okay? And bring it down to just basic layman's terms. So basic math here, if we bought the shares at 62.85, we agreed to sell those shares at 65 from now to expiration. The stock appreciation is $2.15. Is everyone in the chat with me? I mean, we're at basic math now, okay? This isn't like, wow, PhD, here we come. So if we buy these shares at 62.85, we agree to sell those shares at 65 from now to expiration, $2.15. But that's not all. That's my favorite. Okay. Here's the deal. We also get the $1.08, $1.90, because you wouldn't agree to sell those shares for nothing. The $1.90 is for you to keep in the pocket to get you to agree to sell those shares at 65 to anyone in the open market. If you add those two together, you're going to get about $4, and check me on this, $4.15, $4.05. Let me just double check my math to make sure it's correct. Don't want to mislead anyone. Okay, there it is. So that's correct. $4.15. Okay? So if we in this case, if the stock goes up, $405. Now that $405, because you have 100 shares, that's about a 6 or 7% return on the shares. If the stock goes sideways, we don't get appreciation. We get $190, $190, okay? And if the stock actually goes down, the break even expiration, well, it's going to be right around about $60.95. Check my math on that. Why? Well, because you bought the shares at $62.85. You collected the $1.90, subtract those, and we should be somewhere right around break even, $62.85, less $1.90. Yeah, okay, math's working out pretty well here today, okay? So this is the break even expiration. So what is the trend trader of options trying to do? Number one, they're trying to get stock appreciation. They're also trying to actually add potential gain by getting the option premium. Now, if they pay a dividend, could you get the dividend too? You could, okay? Remember, dividends are not guaranteed indefinitely. They could change the policy. The thing is also we're trying to say, look, what if the stock goes sideways? Now, I know your stocks never go sideways, but sometimes mine do. And this is what's nice about the cover calls. If it goes sideways, it's not all for nothing, and I just wasted 30 days of my life. But give me some dadgum premium for being patient. Now, if you're raising children, it doesn't happen like that. Third, if the stock actually goes down, give me a lower break even. Give me a greater chance that I could have a greater chance to have some upside gain. But if it's anything below 60.95, we're in a losing position. Now, trade one, cover calls. Now, if we did this trade, what I want to do is bring this up, okay? Pull this back. And what I'm going to do is now go confirm and send. Now, this is buying the shares of the stock, selling the call. Now, when you sell the call, there's not a commission to buy shares. There's a commission to sell the call. And that's what that looks like, okay? Now, Wacky Wack says my stocks tend to go down. Well, good thing we talked about a covered call then, okay? Now, here we actually go. Now, if we confirm and send that order, it's going to route it to be buy the shares, number one, and then number two, sell the call. Now, let's go back to just real quick. So on this covered call example here, we did the example of BKR. Now, how do you learn a strategy? How do you learn a strategy? Okay. Well, you actually practice it. Well, I'll just do it twice. Not enough. You need it 10, 20, 30, 100 times. How many times you go to work? How many times you go to school, right? How many times you mow the yard, whatever. The moral of the story is sometimes people are not good at investing because they haven't really practiced, okay? So this is what the paper money account is for. Practice a strategy that you might think be applicable to you. Now, I want to go back to just real quick a long call. Okay, let's talk about a long call. Now, what do we say a long call was? Buying a call, the right to buy the shares at the what? The strike price. When someone is along the call, what does that mean? They bought the call. Many investors who are long the call, they're really just trading the call option value. And that value of the call option can really increase by the stock going up. So if stock goes up, and I'm also going to include if volatility goes up. Think like a balloon, right? If we had a balloon, start blowing into it, right? If that volatility goes up, it's going to push up the option premium. The stock price actually goes up, that strike price could become more valuable. The con to that long call is time decay. Now, let's look at a quick example. Now, remember when we talked about, sometimes that the drop in prices might not necessarily always be a bad thing? Remember we talked about that? You remember back in 2007 when the market went down, 2012 when there was a flash crash? You remember in 2020 when there was COVID and we thought it was the end of the world? Remember actually multiple times along the line you thought, man, this market's going to go down? Well, what's interesting is sometimes we got to be careful with that thinking, okay? That there's just doom and gloom. You got to understand that some people use the doom and gloom to get the price to fall on good companies that they actually think are still running effectively, but maybe getting hit by external things in the world. I mean, these are companies, right? Now, I'm going to go back to the example of Apple. Now, Apple announced their earnings. They said they had some supply constraints. They weren't able to sell as many of the products as they maybe wanted to, et cetera, et cetera. Go back and look at the earnings report. But the stock actually fell down to really where it, fell down to where it broke out from, okay? Now, last week we talked about doing a bearish example on that. That trade was about, I think we talked about it on last Friday, about 82% of the good. But this is what's kind of interesting about stock investing or using options. Last week we were bearish, thinking the price was going to drop. Well, that doesn't mean we're bearish this week. That drop, now remember, we always talk about this, okay? When you drop the green candle, the closing price, that's the line of resistance the investor is looking for. Now, I'm going to do this in two ways, okay? Number one, if the investor says, look, I could go out and buy 300 and I could buy shares of a stock that's $311. If I had $10,000, well, $10,000 on about a $311 stock price, it's only going to get me 32 shares. Now, don't say only, but you always want a little more, don't you? Now, but let's say the investor said, James, I don't want to outlay that much capital. I just really want to have a right to buy the shares at the strike price for the intention that the stock could go up and make the option more valuable. All right, so here it is. Now, when we do a long call and we're trying to trade the trend, does the investor have to go 20 to 50 days to expiration? No. Now, here's the thing. This is almost like if you went to a hotel and said, I'd like to stay at your hotel for 3 days, 3 nights, and they give you a price. Now, I'm not talking about anything wacky like the Super Bowl's in the area, it's Christmas, it's Thanksgiving, New Year's, just regular, okay? We know that if we tell them 3 nights, you're going to quote us a price, and then if I tell them, no, I'm staying there for a week, the prices should be going up. Why? Well, because there's more time. Same idea. Now, I'm going to choose the October expiration with 71 days to expiration. Now, the fallacy is, well, if I hold October, if I bought the October, I got to hold all the way to that point. No, you don't. Okay. You might just buy today and sell tomorrow. Buy today and sell in an hour, or try to. Whether you can buy or sell depends upon the liquidity of those options. Now, here we go. Now, in this example, what I'm going to do, and by the way, the reason why we're bringing this up is, we actually got above that resistance as of this morning. Now, we're thinking, could that stock try to reverse back to the upside? Now, in this case, if we buy a call, strike down the middle of the page, you got a 310. If we buy the 310, what does that mean? We buy it, we have a right to buy the shares at 310. Now, I don't want to exercise that right, which means I buy the shares at 310, the investor says. Instead of that, let's say we buy the shares or buy the call at 1610. Now, in most cases, what we would like to see is where the bid and ask are like 20 cents apart. This is 25 currently, but if we move the price down just a smidge, maybe 1605, doesn't mean it's going to fill. But we're saying, look, I want to have the right to buy the shares at 310. Don't plan to buy it. But I think the stock could go up, and if it does, it could influence the option price. Let me just show you what I mean by this. One of the column headings up top, you can click on that, and I'm going to go to where it says option theoreticals and Greeks, and now what I'm going to do is go to what's called theo pricing. Theo pricing is really just saying, well, what if? Wonder if the stock goes up $5, wonder if it goes up 10, wonder if it goes down 7, and you could type in what if, whatever the numbers are, and it's going to spit out the option price theoretically, what it could be. Now, if I do this theo price, right above the bid and ask, we're going to throw out a little example. So let's say today is August 6th, and let's say that we think by next Monday, Sam Flanagan is going to go out and buy an iPhone. And so is Lisa Jack, that are historically been Samsung phone users. Even the Samsung users are jumping and saying, sell Samsung and buy an Apple device. And all of a sudden, the demand just shoots up, okay? Now, if we go to August 10th and the stock price goes up $10, it takes out the time decay, okay? And that upward movement in the stock price now is reflected in the option price. Now, Lisa, let's put Lisa on the line here. Lisa, are you a Samsung user? Speak now, forever hold your peace. Tell us the truth and we can handle it, okay? Oh my gosh, she already did. Unbelievable. There you go. Little fun with us here. Now, that's if the stock goes up. So we buy that call at 1605, it goes up to 21.75. Look at the rate of return, right? This is what they mean by leverage, meaning you're not outlaying the same amount of capital and you're getting a leverage return. All right, now, when you say 1605, is that like $16.05? Like less than a $20 bill? No, it's $1,605. Now, this 21.75 is saying it went up to $2,175. What happens if it goes down $10? If it goes down $10, it goes the opposite direction, right? So step strategy number 2 here, I want you to practice with some long calls. You might use them on some higher dollar stock prices. They don't have to be, because there's leverage here, meaning we're not outlaying the same amount of capital that we would in buying shares. Now, could we put a target on this? Could we put a stop on this? The answer is yes. Now, what I'm going to do is I'm going to move the price to 1610. Trade example number 2, using options and trading the trend. Now, I'm going to go confirm and send. Now, there's reasons why someone would do a long call. Number 1, they don't want to outlay the same amount of capital as buying the shares. Number 2, they think the move is going to be quick. Number 3, the volatility is not as high. Why? That affects the option premium. Lower option premiums equal lower break evens. That break even is at 326.10. So we need that stock, if we held all the way to expiration, we need the stock to go from 311 to, in 71 days, get itself to 326.10. Now, if we go up faster, there could be more gains. But at expiration, we need the stock to be at 326.10 to break even on the option. And remember, when we buy the option, it's 65 cents per contract. Now, let's go back to one other example on IBM. Now, IBM is kind of one that's kind of gone up and down, up and down. And actually, I might want to go to semis given some time. Let me go back to MU for just a second. Let me just take a look at a couple of these. SanDisk, we were looking at a couple of these yesterday. I've just taken a quick peek. WDC, okay, that's the one that had earnings and dropped. I'm just looking at where these are. I want to go back to also Marvel, okay. I might look and see if we can't do like a vertical on Marvel. Now, we don't know. We got to double check, okay? So on these verticals, we're trying to typically do them on a higher price dollar stocks. To me, what does that mean? Probably $300 and higher, okay? Now, if someone did a long call vertical, that is very familiar to a long call. The difference? Well, it's you buying a call, you're long the call, but you're also selling a call or a strike that's higher. So let's kind of take that next step here. Now, the purpose of that is we're trying to get a trade. Now, have you ever said in this run in the S&P 500, oh man, I'd like to get in? Now, this is just in the last 3 years. Okay, someone gets sick when I say this. Wait, what? In the last 3 years, okay, here's the S&P 500 and 4,100. Here's where we are right now. In the last 3 years, it's gone up 85%. Okay, now, that's not saying in the future it's going to go up that. Could go up more. Could go sideways. Could go down. Now, here's the deal. The number one question that people ask is, why does it keep going up? And the simple answer is, there's more buyers than sellers. I mean, why does the house go up? I live in Salt Lake. We're locked between mountains. Why does the house prices keep going up? Well, where else are you going to build? Okay? It's not Denver, where you could just build on the east side of the mountains. Now, the big actually thing is, if we go back to Marvel, we're now going to double check, could we do a vertical? Now, the reason why we're doing this is this has been a stock that's actually been pushed down. It's maybe trying to reverse, has earnings upcoming. All right, now, if we actually come back to the trade tab, we're going to double check, could we? Now, I'm going to show you this example, but you might look for, let's say, something that has a little bit tighter bid-ask spread. Now, number one, what could influence the option prices is liquidity, obviously, but also what affects liquidity, bid-ask spreads on the options and stock, is how quickly the stock moves, but also the stock price. The higher the stock price, the spreads might be wider. Could also be, when I say liquidity, it could be the time of the day, etc. Now, what I'm going to do is, just like we did on Apple, we're going to buy the 210. Now, what we're going to do in this case, we're going to go buy, and we're going to go to vertical. This is like a menu here. right click on the call that you want to buy. Okay. Now, again, think to yourself, how many trades have you maybe missed or not had the education? This is the point of the class, to try to use options to ride those trends. I have been frustrated before that Micron went from $40 to over $1,000 and maybe you didn't have any money because they were already tied up in other investments. You can't get them all. But the reason why some people do options is less capital. Okay. Now, if we right click on that 210, the ask price, go to buy and then vertical. Now, what you're now going to see is we're buying the 210. That's what we did before. And we're selling the 220. Now, if we just bought the call before, it would be 28.80. But since we're buying the call and selling the 220, the net of those two transactions is 433. Why do we care? Well, we care because in this case, what you're now going to see is if we do this, we saw that on a long call, when you buy the call by itself, you got to get the stock to go up more. When you look at a vertical, if the stock is at 212.75 or 70-ish moving around on us, we need the stock to just go up just $1.70-ish from there to there. In 43 days, do we think we could get the stock to go up $1.70-ish just to break even? So remember, the purpose of verticals is number one, probability, but also long call verticals over short put verticals because you're trying to get a higher maximum profit. Now the spread width is 210, 220. Okay, $10 wide. But you got to remember is what did you pay? $433. So $10, the difference there between the strikes minus what is the investor paying? $433. That's where they get the max loss. Whatever you put in, that is the defined risk. How many times have you heard someone say, "I get in the stock market, but yeah, I could lose a lot," and that's true, especially if you don't know what you're doing and you take a strategy and it goes all the way to zero. True. One of the benefits of a vertical is that there's a built-in maximum loss. So if the stock went all the way down to zero, the loss given the vertical is $433. If the stock goes up and closes above the strikes, both of them, the most we can make is $567. So there's a cap to the upside, a ceiling, and a cap, or I should say a floor to the downside. It can only be so good and it can only be so bad given a vertical. Now, these are some main type of strategies when someone's using options to trade the trend. And if someone said, I don't know about cover call, don't know about a long call, know nothing about a long call vertical, short put vertical, long synthetic, these are the tools that investor would need and maybe consider in their portfolio to try to ride some of these trends. And there's different reasons for these strategies. Speaking of that, if you said, "Hey, James, let's go back to that schedule for just a moment," okay? If I said I would like to learn maybe just about options, well, what it does is if we do this, it's going to pull up on our calendar classes that are on options, okay? So if I went to, let's say, trading product, options, it will pull up any classes that we do on options. We teach on a weekly basis. If you said, "Well, what about next week?" These are all the classes we teach about options. If you said, "James, I would actually like to learn just more really about ETFs," that's Friday and Monday, okay? Well, James, I'd really just like to learn more about stocks, okay? And there it is. I like to learn about how to manage my portfolio. What do you want to learn, okay? So whatever you want to learn, there it is. And if you said, "James, I really honestly, I know nothing, and I just want to do on a beginner level," then what you can see is you can pick the classes on a beginner, an intermediate, or an advanced level. Now, here's the thing. Some of the things I talked about are maybe applicable to you, okay? The biggest actually thing is you might have kids or grandkids that are also trying to learn about the markets. Let them know about it and tell them. One way to actually learn is just like you went to college is you take classes. And our webcasts are a format to learn. Now, last thing is I'll just make mention of, we have also some live events. We are going to be in Orlando this weekend. Check that out. We also have 1-day events or 2-day events on different topics. See that lineup? We could be in your area. Now, also in the chat, there is a survey with 2 questions. And if you said, you know what, James, and those 2 questions are, how likely would you be to recommend Charles Schwab to your friends, families, and colleagues? And second is, how satisfied are you with the Trade the Trend webcast you attended today? Just 2 questions. And if you'd like to write some comments of things that you'd like to learn about, let me know. Thank you in advance for filling that out. Now, remember that also, just real quick, in closing here, we went over a couple key strategies, and we want to have you go out now and practice those strategies in your paper money account. Now, coming up next, we have a class that will get more on verticals coming up next. I want to say thanks to all of you, and also Scott Thompson as well. Remember that all investing involves risk, and this has been the class on Trading the Trend. Thank you so much for attending today, this live session, and also all of you are on recording as well. Feel free to join us weekly, and don't forget to subscribe and give us the thumbs up. Thanks so much. Take care. Stay tuned for our next webcast coming up at the top of the hour. Take care. Bye-bye.